Hi, I'm Ben and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Due to the recent global issue, the economy has been put in deep freeze. This has meant that the velocity of money and the amount that people are spending has also decreased. With the central banks lowering interest rates in a bid to stimulate the economy, bank stocks have took a major hammering. So is the world about to end, or is this the greatest time to invest in some bargain stocks? If you believe like me that the economy will recover as it has done so many times before from previous recessions, then now could be a great time for you to start investing. Lloyds Bank was founded in 1765 in Birmingham, UK. It began when John Taylor, a button maker, and Sampson Lloyd, an iron producer, joined forces. They started a bank called Taylors and Lloyds, which served manufacturers and merchants. Lloyds Bank expanded throughout the Industrial Revolution, and by the 20th century, Lloyds Bank had acquired many smaller banking groups and then expanded internationally. These days, Lloyds Bank has over 30 million customers and is well regarded as one of the big boys of the UK banking industry. Lloyds' share price has fallen nearly 60% since the start of the year. This far exceeds the 30% drop in the FTSE 100. The announcement that the bank would suspend their dividends also didn't help the situation. Is the bank doomed? Or could this be a great turnaround investment? In this video, I'm going to give you a full analysis of the stock and detail whether this could be a great investment opportunity. Before we get started, go ahead, smash that like button and subscribe if you haven't already. Be sure to turn the notification bell on, that way you'll get notified when I release future videos and stock picks. It's good to be first on the scene when an interesting stock is at a great price. Central banks from around the world have unlocked trillions of dollars worth of funding to make sure the financial system stays liquid and doesn't collapse. So far, their measures seem to be working. Reduced interest rates and more liquidity will make it easier for the banks to lend. Lloyd's share price is now the cheapest it's ever been since 2012, shedding over 60% of its value since the start of the year. Lloyds Bank's price to earnings ratio is just 8, which is massively lower than at the start of the year. So how did Lloyds Bank perform during the financial crisis in 2008? Lloyds Bank was hit hard during the 2008 financial crisis, as were many of the other large banks. Problems at Halifax Bank of Scotland led to a catastrophic fall in share price. HBOS was about to fail. However, this is where Lloyds came out stronger. Although it went against the rules of the Monopolies Commission, the government allowed Lloyds Bank to take over Halifax Bank of Scotland. This acquisition by Lloyds Bank made them the largest holder of mortgages in the UK. The UK government bailed out Lloyds with a £20.3 billion package. This gave them 43% ownership of the bank. In 2017, the UK government finally sold its last shares in Lloyds Banking Group. Lloyds Banking Group has battled many scandals over the recent years. From allegations that the bank mistreated its customers during the financial crisis as it fought for survival. This led to a £45.5 million fine for the failure of its Bank of Scotland arm to tell the city watchdog about suspicious fraud at its now notorious Reading branch. According to The Guardian, the proceeds of this fraud were spent on prostitutes and parties. Now, although £45.5 million isn't a lot for a large banking institute, the stigma is still there. Then there was the IPPI Scandal, the Payment Protection Insurance, which affected many British banks, in which they had to pay £53.3 billion. Lloyds Banking Group was unluckily the biggest seller of this dud product. Now, despite these scandals, Lloyds Banking Group had battled and recovered, and its share price was looking really healthy up until this latest stock market crash. While it's unlikely that any of these banks will escape unscathed from this recent stock market crash, they are in a far better financial position than they were during the financial crisis of 2008 and 2009. So it's clear to see that if they recovered from that, then they should definitely be able to recover from this. Deep diving into the stock here, we can see that Lloyds Banking Group is now trading at 26.4% below its fair value, with earnings forecast to grow at 15.96% per year. Looking at the risks, we can see that it's had a highly volatile share price over the past 3 months, which would be expected due to the global issue. It also said profit margins have been decreasing compared to the previous year. Looking at its valuation, we can see that its share price versus fair value, 26.4%. Now this software calculates its fair value as approximately 41 pence a share, and it's now currently selling for 30 pence a share. I believe I purchased the Lloyds Banking stock when it was approximately 20 pence a share, so it was even lower in terms of its fair value. PE ratio, so Lloyds has good value of 8.6 PE compared to the UK market of 13.2. Price to earnings growth ratio, good value, 0.5. Price to book ratio, good value, 0.4 compared to the banking industry average. Future growth forecasted at 16%, which is fantastic. Past performance, 28.7% historical annual earnings growth, which is also great. Financial health. Now, here with financial position analysis, this is a very, very important part to check up. So what you want to be looking for, ideally, is that a company has less liabilities than assets. Now, as you can see here, this is the risk with this stock. It's got more liabilities than assets in the short term, which is a risk. However, in the long term, it's got more assets than liabilities. So if it can withstand this sort of short-term issue, and obviously all the central banks are helping out the larger banking institutes by lowering interest rates, which does decrease their profits on loans. However, it also allows them to borrow from the central banks at a lower rate. So the main central banks in Europe are supporting the other smaller banking institutes. So this is the risk, but with the central bank support, it's not as big of a risk as it potentially looks here, I would say. But that's just my opinion. Now you see the balance sheet there, that's the debt. That's what we're worried about there. So this is a financial institutions analysis. So it's got mostly ticks here: asset level, low risk liabilities, loan level, low risk deposits, level of bad loans. It says it's got no allowance for bad loans, so be careful on that. Dividend, fantastic dividend, 8.56%. Experience management, experience board. Insider trading, now this is a really interesting part to check up. So what you want to be looking for, ideally, if there's been some sort of crash or some sort of incident, you're looking for more shares to have been bought than to have been sold. So as you can see here, which is great news, insiders have bought more shares than they have sold over the past 3 months. So as you can see here, from the 17th of March, there's been some shares purchases, 12th of March purchase, 30th of December purchase. Now, 30th of December here, this was before the sort of major issue. So there was a few sell-offs here, significant sums. However, during this crash, and especially when it's been hitting the UK, there's not been a massive amount of sell-offs, which is a good sign. Shows that the company board at least has faith in their business in terms of they're not buying or selling their shares, they're just holding, which is a good sign. There's obviously been a couple of purchases as well. Overall, UK banks are in a much stronger position than they were during the financial crisis of 2008, where they had to be bailed out. In this case, the 2020 stock market crash is not the fault of the banking institutes, and that has just acted as a catalyst for economic volatility internationally. If Lloyds Banking Group can preserve its capital and continue lending to small businesses, then it should be able to survive. However, with many small businesses going bankrupt due to this recent global issue, that could eat away at the bank's profits, which is a small risk. However, if Lloyds Banking Group can continue to support small businesses in a cash efficient and disciplined manner, then it should be able to get through this short-term issue. Combine that with the really low share price at the moment, I believe this gives Lloyds Bank a margin of safety when investing. So I did purchase shares in Lloyds. You should also check out my previous video in which I analysed shares of Barclays. Now it's clear to see that this bank is one of the cheapest in the FTSE 100 right now and offers potential returns of 300% upwards. It's even a better deal than Lloyds Bank. I'll leave the link below. Be sure to check out my other videos where I analyse 5 stocks I purchased during the previous stock market crash, which has seen me up by £1,000 in just 7 days. Now, as a long-term investor, this increase doesn't really make a difference to me, but it's still nice to watch your portfolio grow over such a short period of time. This suggests a possible V-shaped recovery from this recession. I also have a video reviewing the free trading apps which make it really easy to get started investing. I've included a couple links below which will give you a free share when you sign up. But remember, on this channel we don't give financial advice. So please evaluate the stock yourself, research it yourself, assess your own investing goals and your own budget before investing into any stock we mention on this channel. So what do you think of Lloyds Bank as a business and as a stock? Please do comment your thoughts below. And if you enjoyed this video, go ahead, smash that like button and definitely subscribe. Now I will leave you with this classic banking joke. A local bank set up a cash machine inside a tree. If successful, they plan to expand to other branches. See you next time.